Hello, I'm Devon Coombs, CPA, MBA, finance lecturer at San Jose State, ex-Google, and Deloitte, and a top consultant in the Bay Area. Today, we're going to cover the fundamental theories behind portfolio management. Imagine you're a portfolio manager. Your job is to build a smart investment portfolio that can handle the ups and downs of the market. To do that, you first need to understand what you're up against. Investment risk. Imagine your client has all their money in just one company. Pick one you know, like Apple or Starbucks. Now picture a disaster that only hits that company. Maybe a product recall, a big scandal, or a failed project. Suddenly, its stock price falls sharply. This is called unsystematic risk. It's a problem that's specific to one company or its industry. Think of it like a single leaky pipe in a huge apartment building. It's a big problem for that one apartment, but it doesn't affect anyone else. Now let's think bigger. What if there's bad news that affects everyone, like a global recession, a surprise jump in inflation, or a major war? When this happens, nearly every stock goes down, no matter the company. This is systematic risk, or market risk. It's like an earthquake that shakes the entire building. Every apartment is affected. You can't get rid of this risk completely, but you can prepare for it. So, how do you fight that first type of risk, the company-specific problems? The answer is the most important idea in investing: diversification. If your client only owns that one stock when disaster strikes, they lose a lot of money. But what if they owned that stock plus 20 other different companies? When that one company has a bad day, the other 20 are likely doing just fine. The portfolio might dip a little, but the damage is cushioned by the success of the other investments. By owning a mix of different things, you make sure that one company's bad news doesn't sink your entire portfolio. So why does this work so well? The secret isn't just owning a lot of stocks. It's owning stocks that don't always move in the same direction at the same time. This relationship is called correlation. When a stock has a high correlation, or a correlation coefficient, also known as P of 1 or close to 1, these two stocks are like identical twins. When one goes up, the other goes up. When one goes down, the other follows. Putting them together doesn't help much because they share the same bad days. When an investment has no correlation or low correlation, where P equals around 0, the stocks are like strangers. The movement of one doesn't really predict what the other will do. Owning these two investments is more helpful from a diversification perspective. When stocks are negatively correlated, or P equals or is close to -1, the investments are like perfect opposites. When one zigs, the other zags. An example of this is if there was one company that only sells sunscreen and one that only sells umbrellas. Each company will perform oppositely in a year of no rain compared to a year of heavy rain. Now here is the real magic of diversification, and it's a mathematical one. When you combine two assets, your portfolio's expected return is simply the weighted average of their individual returns. That's straightforward. But here's the key. Your portfolio's risk is actually less than the weighted average of their individual risks. You get the average of the return, but less than the average of the risk. Let's use an example. Imagine you have two different investments. Both have an expected return of 10%, and both are considered individually high risk. If these two assets just happen to be perfectly negatively correlated, meaning when one goes up, the other goes down by the exact same amount, a fascinating thing happens. By combining them, your expected return stays at 10%, the average, but the overall risk is dramatically reduced, potentially even down to 0. The two opposing risks have effectively canceled each other out. This powerful relationship is all defined by the formula for the standard deviation of a two-asset portfolio. This formula specifically includes a variable for correlation, showing mathematically how this works. In future videos, you'll get to practice using this formula to see exactly how changing that correlation number impacts your total portfolio risk. So, the core to smart investing is understanding these different types of risk and grasping the importance of asset correlation. This is how you leverage diversification to build a stronger, more resilient portfolio.